Hi everyone, and welcome to the Everyman Investor. This video will be the last video in the series on getting started with equities, and today I shall be covering something that I don't usually use, but it's something that you will see very often on many of the financial sort of news channels, and also when analysts talk. So today I'll be covering technical analysis. Namely, I'll be covering three things that are most commonly mentioned: the moving averages, the VIX, as well as the relative strength index. Okay, so technical analysis, the most commonly used technical analysis indicators are the moving averages, usually the 50 and the 200-day moving averages. These basically are the trend lines for the stock price over the past 50 days and over the past 200 days. The common terms you'll hear will be the golden cross and the death cross. So the golden cross is basically a bullish signal whereby stocks are expected to move upwards. This is when the 50-day moving average crosses above the 200-day moving average. And the death cross is basically a bearish signal whereby stocks are expected to go downwards, and this is where the 50-day moving average will cross below the 200-day moving average. Now, the second bit of technical analysis you will hear about was the VIX. So this is the volatility index, which predicts the market volatility going forward, and it's useful usually for buying in a bear market that is a deep bear market. And lastly, I'll use the relative strength index. This is what I usually use if I do technical analysis. So usually the RSI will be overbought if the RSI is above 70 and is oversold when the RSI is below 30. Now, usually if it's overbought, a stock will be predicted to fall, and if it's oversold, the stock will be predicted to rise. However, this is not always the case, as I'll show you in the next couple of slides. So, if this all makes no sense to you, don't worry. I'll try and explain it in ways that are easily understandable. It took me a while to figure all this out as well. I started with the RSI and the VIX and basically moved on to the moving averages. But as I mentioned, I hardly use it because to me, the fundamentals of the company as well as the valuation are much more important than all these technical analysis indicators. So the moving averages, like I mentioned, the most commonly used is the 50-day and 200-day moving average, and indicates the trend line of the stock. The golden cross, as I mentioned, is a bullish indicator where the 50-day moving average crosses above the 200-day moving average. Now, some people actually use the stock price crossing above the 200-day moving average as the golden cross. Now, conversely, the death cross is a bearish indicator where stocks are expected to go downwards. Again, some people use the 50-day moving average crossing below the 200-day, and some people use the stock price crossing below the 200-day moving average. Unfortunately, as I mentioned, this does not give a fair valuation estimate of the company, which is why I hardly ever use it. In fact, I don't think I've ever used a moving average indicator to buy a stock. So I was looking at the price action of Darling, DAR, the ticker, when I was sort of preparing this presentation, and I decided to take a look at the moving indicators to see whether or not this will provide good indications of where to buy or where to sell the stock. Now, as you can see, Darling share price has been dropping quite a bit recently. In fact, it's been on a downward trend for most of the past year or so. It's a very interesting company which I haven't bought yet because I haven't figured out why the share price is dropping so much. And I have not been able to assign a fair value, which is why I've held off buying. So let's take a look at what the moving indicators indicate. Now, this is the golden cross, where the purple color line, which is the 50-day moving average, crosses above the 200-day moving average in the red color line, and the share price was $68.91 during that crossover. And this is where the death cross was indicated, whereby the purple color 50-day average moving line crosses below the 200-day average moving line. Now, as you can see, if you had used purely technical analysis to buy when the golden cross was triggered and sold when the death cross was triggered, you would have lost money in this case, which is why I do not actually believe in using the golden cross or the death cross as indicators for me to buy a company. Now, had you used purely the share price for the crossing over the 200-day moving average as the indicator for the golden cross and death cross. You can see this is where the golden cross was triggered, and this is where the death cross was triggered. Again, you have lost money if you had bought the stock purely on technical analysis, using the golden cross and the death cross as indicators of your buy and sell points. So now let's look at the VIX. So the VIX is basically indicative of the predicted volatility of stocks over the next 30 days. It's especially useful in deep bear markets. In fact, some analysts actually use the VIX as the indicator to call the end of a bear market. And it is the value of it basically is, some people will say that above 30 is a buy signal. Some people will say that when the VIX is above 40, there will be a buy signal. But I would say that it is pretty useful in terms of buying during deep bear markets, but to call the end of a bear market itself, it is premature at times. And also during shallow bear markets, the VIX actually does not trigger the above 30 to above 40 buy signal. So now let's have a look at the SPY over the past 5 years, as well as the VIX over the past 5 years. So as you can see, the SPY is in the light blue line and the VIX is in the black color line. Okay, this is where the 30 is for the VIX, the red color line that I have put in. Now you can see that whenever the VIX hits above 30, the share market or the share price for the SPY tends to be either bottoming or nearing the bottom. Unfortunately, as you can see, a lot of times the VIX does not actually cross above 30. And even if it crosses above 30, sometimes the share market or the share price for the SPY actually is on an upward trend. Hence the reason why I say that it is not exactly the best indicator of calling the bottom for a bear market, and also hitting above 30 does not necessarily indicate that the stock market is going to continue going down or it has stopped going down and it is on upward trend. It is, in general, I would say, decent indicator of markets going to be on upward trend soon, but only at extreme values. So if you can see in the past 1 year, which will be somewhere here, so you can see that the VIX has actually never crossed above 30, but there have been dips here and there have been peaks here, and that's why I say the VIX is only useful mainly in deep bear market territory, which will be during this period of time here, which will be the COVID crash. As you can see, the VIX actually hit above 50 during that period of time, and if you have bought then, you will have made quite a bit of money. But as you can see, there are multiple peaks here above 30, but the share price continues to go upwards. So this is something that is good to bear in mind and to know, especially when you're watching financial sort of news channels, but it's not something that I will use just purely for buying the dip. Now, the last indicator which I do use actually is the relative strength index, or the RSI as they call it. So it indicates whether a stock is overbought, whether it's in the normal range of its sort of RSI strength, or whether it's oversold. Now, typically people use more than 70 as overbought. Some people use above 80. And the RSI 30 to 70 will be the normal range of stock price, sort of volatility. Less than 30 will be oversold, or less than 20 in some cases, some people use as oversold territory. Now, the accuracy can vary depending on market conditions. Again, I emphasize, never use any one indicator as your cue to buy or sell a stock. How I use the RSI? Okay, so basically, if I find a stock that I think is a great company, and I think it's fairly valued, I might take a look at the RSI if I'm not convinced 100%. And if it's overbought during that period of time, I might actually wait before buying the stock, because it is maybe going to drop, or there's a likelihood that it's going to drop. Now, on the other hand, if I find a buy point for stock that I think is fairly valued and it's oversold, that will reinforce the fact that I probably should go into the stock at this point in time. Okay, so all these charts basically are from Yahoo Finance, and you can actually get all these from the indicators here. If you click on this, you can see the RSI, you can see the moving averages, and all these things basically are very useful, which is why I use Yahoo Finance charts very often. So as you can see, the RSI chart is here, again for Darling stock. So you can see these are periods whereby the RSI has indicated that the stock is overbought. Now, in the first instance here, you can see that after the overbought signal is triggered, the stock price actually drops. So the RSI is basically correct. On the other hand, if you see here, the RSI actually triggered overbought signals for a long period of time, but the stock price continued to go up. Now, conversely, this period here is where the stock price has been dropping. It's been up and down, but mainly it's been a downward trend. But the RSI has never signaled that it's been oversold, which is basically under the red color line here, which is the 30 mark, until recently. So as you can see, the RSI itself is actually not a great indicator for how or for when to buy a share. Again, you need to look at the whole picture, the fair value of the share based on either your preferred metrics, PE ratios, PS ratios, or free cash flow ratios. And then if the RSI sort of reinforces that buy point, that will probably be a good point to go in. But never ever use technical analysis as an investor as your sole buy or sell point. Now, to illustrate this, I will show you basically a stock that I bought recently. So the moving averages are as follows. The red color line is the 50-day moving average, and the green color line is the 200-day moving average. As you can see, I've left out the ticker symbol of this stock because I prefer you to buy a stock that you want to buy rather than a stock that I have bought. Okay, you can see here the red color mark in line here indicates when the death cross was triggered. So the 50-day moving average crossed under the 200-day moving average. Now, if you use the share price, this is when the death cross will have been signaled, where the share price goes under the 200-day moving average. This is the most recent death cross. And this is where the golden cross was triggered, where the 50-day moving average and also actually the stock price crossed over the 200-day moving average and above 200-day moving average recently. Okay, this is where I actually bought. So basically, I ignored all the rules. As you can see, the RSI here is actually not in oversold territory. The moving averages basically have showed that this is actually a bearish time to buy, but I bought it because the stock actually reached the PE ratio that I thought was fair valuation, which is below the median PE for this stock. As you can see, since then the stock has been going on an upward trend over here, which was correctly signaled by the golden cross. But had you bought during the golden cross, you have missed out on some of the gains. And also, as I mentioned previously, showing the Darling charts, golden cross does not necessarily signal that the stock is going to go up and you're going to profit for sure, which was a few slides back. So in conclusion, investing in stocks is hard work, okay? It took me 2 years to learn how to find a wonderful company, to fairly value a company, and as of now, I only have 13 stocks that I own that I handpicked, plus some stocks that are still left over from the subscription services that I subscribe to. It takes me weeks, sometimes months, to find a company and value that company, and there are no shortcuts, to be very honest. So I read a recent article on CNBC from one of the free newsletters I subscribe to that says that most people take 5 minutes on average a day to actually look at their stock portfolios. And that probably explains why a majority, more than 70% of people actually lose money in the stock market. The success that I have recently, so I took a look at my portfolio before I did this presentation. Of the 13 stocks that I bought, 9 are solidly in green territory. They're making money. One is sort of bouncing up and down, green, red. 3 are solidly in the red line. 2 of those are unprofitable companies that I shared with you in my previous presentation on my portfolio. And those companies I'm prepared to wait because my investment thesis remains intact. The other company basically is sort of a victim of current macroeconomic prices for the product it produces, but I'm holding on as well because my investment thesis is also intact. So as you can see, even after so much work, every day at about 8:30 my time where I stay, the stock market opens about 1 to 2 hours after that, because I stay in Asia. So it's about 12 hours difference or 13 hours depending on whether or not there's daylight savings. I spent almost 2 hours going through my emails, going through the newsletters I subscribe to from the various websites that I've told you about during this whole series of presentations. I go through some of the earnings reports. I listen to the earnings calls and earnings and read through the earnings presentations. So I just recently sat through the earnings call of the stock that I just bought that I show you the chart of, and the earnings were very good, which is why the stock price actually shot up. But I have been following this company for months, and I've been waiting for an entry price that is below my fair value. There is no shortcuts to investing in the stock market. That is the reason why I do not provide tickers for most of the stocks that I have bought. Not because I do not want to share with you the success, but because in many cases a lot of these companies have shot up and they are beyond the fair value, and I do not want you to buy a stock that is beyond fair value already. Also, everybody has got a different idea of what a good stock is. For example, I do not buy stocks in the oil and gas industry because I see that as a declining industry. Now, would those stocks decline over the next, say, 2 to 3 years? I would say there's a good chance they might go up, and that is where my opinions may differ from you. For example, you might be strongly in the camp that oil and gas companies will be profitable and will be growing earnings in the next 2 to 3 years' time, given how the renewable energy sort of transition has stalled, and how a lot of the oil and price sort of production, oil and gas production has been affected by recent macro events, including the recent, unfortunately, tragedy in Israel and the subsequent war. And that is why I do not want to provide you with stocks. I want to provide you with a method to find those stocks, so that when you buy a company, you have your own investment thesis, you have your own ideas on why you're buying that company, and you are convinced and you have the conviction that you're buying at the right value. Again, there are no shortcuts. It is a lot of hard work. So set your own rules and limits. Do not chase a stock up just because the stock looks fantastic. For example, if you have bought Nvidia at, say, $450 because a crazy analyst tells you that it's worth $700, it is nuts. The recent US sort of curbs on chip sales has affected Nvidia stock tremendously. I have not chased it beyond $250 because I do not think that it's worth that much. So I'm still firmly in the green and I'm still holding on to it. But the thing is, there are always other companies to buy. So this company that I showed you in the chart recently, and that I mentioned that I listened to the earnings call over the past couple of days, was a company that I was actually looking at, but I had not put a buy order. In fact, I had a buy order on another stock. But when the share price dropped after some news was sort of reviewed, I actually just cancelled my buy order for that stock and bought this stock instead. So there will always be good companies to buy. Now, admittedly, there's a limit to how many good companies there are. But there are so many companies out there, it is not hard to have a short list of about 20 to 30 companies that you are looking at. I would say that it's probably a bad idea to have too many companies in your portfolio, because the thing is you need to follow every single one of them. And you need to basically know the news that's going on for every single one of them. I personally have set a limit for myself of about 20 companies at most. I'm at 13 now, and I'm in no hurry to buy another company unless it is at fair value. I am following up the news of every single stock I have, which is why I said that for those two stocks that are unprofitable, they are in red territory at the moment, I'm prepared to hold, because to me, my convictions when buying those stocks, and although it has dropped by, in some cases, 50% at times, my conviction that the company can still execute and will become a profitable company and will be trading at a much higher price than what I bought it for in the future is still intact. Now, will I sell if that changes? I might, to be honest. So basically, please keep updated on your earnings call and your earnings reports. It's very important. Ensure that your investment thesis is intact. Is when I will sell. My investment thesis is broken. If I have to take a loss to sell, I will sell it. But while the investment thesis is intact, I will hold on to those stocks. So, conclusion, hope this series of presentations has given you an idea of how the best investor I've known, which is Warren Buffett, buys and sells companies, how I have found success after initial losses in buying buying companies that I think are great companies, and how the thought process behind buying those companies goes, and also when to sell in terms of when your investment thesis is no longer intact. And I hope that this whole series of presentations will enable you to make profits in your own investments. Now, I will continue on a series on other investment vehicles, and I hope to see you in those presentations. As always, thank you very much for watching. If there's any news, which the next news will be the Federal Reserve release of their dot plot for their next sort of meeting, I will probably do a presentation on that and explain what exactly a dot plot actually means. I know it's all Greek sometimes, but as investors, it's a continual learning process. I was watching quite a few videos on Warren Buffett yesterday, and I learned again that it reinforces some of the lessons that I've learned over the process of buying my stocks. And I do think that it is necessary for us as investors to continually keep learning. We can learn from each other, we can learn from the best, and we can also learn from those people who are losing money in the stock market. We learn what not to do in those cases, which is why I shared with you how I lost money initially in my first year when I invested in stocks. Those are things that I will not do again, and are also things that I hope that you have learned from my mistakes not to do, and also from how I have sort of learned from there, and the lessons and rules that I've set for myself, and I hope those will help you to earn profits as well. So thank you for watching, and I hope to see you in my next video.